Afternoon, folks. I'm an associate member of T3 Trading Group, which is an SEC registered broker dealer and member of FINRA/SIPC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. There is my position disclosure. So I got back into core weave today. I've already been in ARC. I started a new position in coin. I day traded it short yesterday, but I didn't keep it. Kept a little bit today. I got back in Circle. It's a real small position. I got in Roblox. It's a real small position. I got in Microsoft. It's a very, very small position. So some new position disclosures on the short side, but the sizing is pretty small. So the market closed up. SPYs here up 0.7% on the day, and we're actually off 50 cents from where we closed, so even higher than that. It's like a 0.75% up day for the SPYs. The Qs, similar deal. They're pulling off their high, but 0.9% positive for the Qs. And the IWM was the real leader, especially in the last hour. The Russell really picked up steam in the last hour to close up over 1.5% on the day today. So this is bearish as it gets. The market being up 0.75% is as bearish as it gets. What do I mean by that? Why am I saying that? Is because from a market dynamic perspective, right now, these last few days in the month, we've got a large pension rebalance selling in equities ahead of us. I think it was 27 billion expected to sell, if I got that number correct, into the end of the month. It's in the 86th percentile. Don't 100% quote me on that, but I'm pretty close on the number. So there is some degree of you know bearish market dynamic selling between now and the end of the month. But once we get to the beginning of July, watch out. So this move here, where we broke out 3 days ago and we're going higher every day, and today we closed up another 0.75%. That's the question. Is this as bearish as it gets? Because once we get into the July period and that vault control 3 month look back window rolls off and we are met with $5 to $6 billion worth of buying a day, um, it's gonna be it's a lot. It's really gonna insulate any possibility of going down unless something major happens to be able to trigger us below some key levels. So yeah, market being up 0.75%, is that as bearish as it gets? That's my question that I'm asking with only a slight degree of sarcasm. I wish I was being fully sarcastic on that, but it just seems like this market is totally set to ramp up. Um, the SPY is not an all-time high. Did the SPX give us an all-time high today? What's this high? 61.44. Where did we close today? 61.41. So it looks like yeah, barely no. We're $3 off all-time highs from the S&P. So I'm sure we'll be there in like an hour or so. Um, but jokes aside, the market's really bullish, but it hasn't extended. We've kind of been in this grind higher for these last few days. It has not been like a real momentum breakout. Um, Obviously, there's been some degree of extension compared to the 2 month consolidation that we had just been in, maybe month and a half consolidation that we had just been in. But the SPYs here are sitting at $7 of upside extension from the ADMA on the daily, and that EDMA will be higher tomorrow. So we're not getting into extreme extension. For the Qs here, we're closer, but still not there. About $9, almost got to $10 of extension from the ADMA on the daily today. Again, that ADMA is going to be a little bit higher tomorrow. So, this market has been really trooping higher, but not with so much momentum that it gets us extreme extension where you can feel really confident, or more confident, I should say, to go in on the other side of the market for some sort of a technical pullback. We haven't gotten there yet. So today's trading session in particular, yesterday there was some degree of this also, but today's trading session in particular, it just seemed like from an index level, you can't really buy here on day three after the market is breaking out with a moderate degree of extension, but it just is a little bit too early to be shorting outside of maybe some individual stocks that are in a world of their own, or have some relative weakness. It seems like it's too early to really be shorting. That's why, the new shorts that I did put on today, uh, what I'm keeping is very, very small right now. So I've got a little bit of wiggle room to build into the upside. If we have another update tomorrow, maybe we'll start to trigger into that extreme extension point. I would imagine with the IWM's move, though, that short term tactical will be a little bit cooked to the upside tomorrow. It'll probably be in the red. But again, short term tactical being in the red, and it barely closed outside of that for the last two trading sessions in a row. Short term tactical in the red doesn't mean shoot; it means don't buy. So it's potentially we'll see how we go, but there's a good chance that tomorrow we're going to be in the exact same boat as we were this morning, where it's just not a great risk reward to be really chasing to the long side. That trade was a couple days ago, and that's it. The market broke out. There were so many individual stocks that you could have bought that day. And I just want to reemphasize an important trading point that I think I discuss a lot. Um, Not every day, not every trading session is created equal, right? So certain days there's going to be more opportunity than others. And the cool thing about the way that I like to approach markets is sometimes you can do a lot of work and then that one day is really there and you do a lot of execution on that day and then you continue to get paid from that execution for days at a time. So the day to get yourself paid was two trading sessions ago to buy the breakout in the S&P, to buy the breakout in the Nasdaq, to buy the breakout in Meta, in Nvidia, in a whole host of other stocks that we were mentioning on that day. And then yesterday and today are days just to continue to get paid. So that's why it's so important to recognize the market works in periods of expansion and consolidation over time. The consolidation periods, while they can be sometimes a little frustrating from a trading perspective because there's not much going on, but those consolidation periods, they create the setup for the expansion period. And then it's through the expansion period that if you execute well, you can get paid. And that's just how this market was, right? We pretty much spent all of the entire month of June more or less consolidating some hectic headlines with Iran, Israel, all that stuff, a little bit of a pullback, but we had very clearly established this like 605 as resistance. And then two trading sessions ago, we kind of had a gap and go into that 605. And I remember on that morning meeting, we had all these different stocks that we were looking at for longs. So you kind of had to wait almost the entire month. And I'm not saying don't trade for the entire month of June up until two trading sessions, but that's not what I'm saying at all. um what I'm saying is you kind of you know pick and choose your spots. You be a little bit more conservative. You be a little bit more cautious. You kind of grind a living out for yourself during the consolidation period, which is most of the month of June. But then when you get the actual breakout that occurs, which is two trading sessions ago, after you've been waiting for a whole month for that setup to build out, that's when you really want to execute. That's when you want to be more ferocious, put more risk on, and get paid. And then again, you execute well on that setup two trading sessions ago, and not only do you make money on that day, you make more money yesterday when you get continuation. You make more money today when you get continuation. There's a good chance you make more money tomorrow when and if we get further continuation. And I just think that that's a really big important part about becoming consistently profitable because what I've learned a long time ago from other traders who are more experienced than me when I was newer, and probably a little bit more for myself over the course of the last handful of years, is that a lot of the best traders, the real seven-figure traders that are out there, they probably make the majority of their year over the course of smaller periods of time within that year. It's a month here or there that worked out perfectly for them. it's a trading session here or there that was a big important day like the one from 2 days ago, and then you continue to get paid on that, like, as I'm saying, for the next couple of days just off that really good execution. So that's kind of where we're at. Today was difficult because now it's day three. We were gapping up on that day three, but we weren't at extreme extension, and the micro earnings, and it's interesting. Micro closed like flat red on the day, but that micro earnings report was phenomenal. And what we were reading out loud off of the Goldman Sachs note this morning, which was kind of already where my train of thought was that the Micron earnings report's important for Micron, and there was a very high bar going into that report because of how much Micron was up into it, and their report was phenomenal. So it almost matters less what the Micron price action was today. It was a little bit sloppy. It ended up kind of flat, small down. It's more, I think, actually the read through to the rest of the semiconductors. That micro earnings report was so good that it continues to kind of bolster that sentiment for the AI trade, for semiconductors generally, which is why, like, my only real idea of the day today was SMCI on the breakout. We talked about going long kind of at the open versus $46. It worked. Um, it worked really, really perfectly. Uh, um, nice. It worked really perfectly. It felt a little bit chasey, but it wasn't too bad. And when you combine it with the sentiment that could be coming from Micron, the stock could potentially go. So that was like the only real big idea I had. I've been eyeing some of the extension in a couple of these names that we've talked about. Like we've talked about, Roblox, this upward channel that it's been. I almost want to see this upward channel break up and go parabolic because I think that will actually create the setup that'll be the end of this up move. So that one's kind of on the radar. And again, I started a real small, um, a real small feeler. We're not really moving on that headline. Deal signed. Trump says signed with China yesterday, starting to open up China. I don't really know what that means, but the market doesn't seem to care too much. Alibaba's up at not even a lot. Alibaba's up 50 cents. Um, Whatever. So Roblox, that chart pattern with that channel breaking up, interestingly enough, I actually feel that's what Microsoft has started to do. So I kept a very, very small short in Microsoft overnight tonight. I am a big fan of this company. I loved that earnings report in the beginning of May. It's been one of my favorite names to be long in the entire S&P of the Mag 7. It's been trading great. Microsoft and Meta are probably the best non-semiconductor names right now to really be long. But this thing had been in this upward grind off this ADMA, and now just a few trading sessions ago, it really started to break out above that. So it's starting to go parabolic here. So again, I just kept a very, very small little feeler in this thing to the short side. And I ended up doing the same thing with Roblox, just real small kind of feeler positions. Circle continues to kind of pay. I waited till it approached like 220 to reinitiate a small short. I added a little bit above that. Then I pulled back when it closed. I took a little bit off and I kept a small amount. CoreWeave was interesting that this did not sell off on the cores news at all, which I don't even know if this is substantiated or not, but we saw a headline coming out today that CoreWeave is potentially going to be making a bid for Cores, CORZ. And CORZ is at what, 30-40% on that? Closed up like 35% or so. Typically, the company that does the acquiring um, gets hit lower, and the company being acquired obviously goes up because you're being acquired at a premium. The interesting thing about this was if you looked at the CoreWeave price action, it almost seemed like CoreWeave was saying that this deal isn't true, it's not real, and it's not going to happen. But if you look at Core's, which is up 37%, 35%, Core's is definitely saying it's going to happen. So I don't get it at all why the CoreWeave didn't slow down harder on that. I don't know how they're going to be able to buy cores, assuming that it's even real. It seems like CoreWeave already needs to raise additional cash just for their ongoing operations, and now they're going to make an acquisition. Either they're going to be doing that through cash, which they're already short on, or they're going to be doing it through some sort of a stock deal, but that would further dilute the float basically. So the stock absolutely refuses to go down, and that's just the environment that we're still in right now. I think with this market, up, up, up and away. And I guess it circles back to my starting half joke, which is the S&P is up 0.75% on the day. This as bearish as things get, and we'll see. So that's all that I've got. A little bit of a quieter day. It feels like it's been a little bit of a quieter week actually. I know we had kind of a holiday weekend last weekend. Trump declines to comment on what type of deal was signed yesterday. So it's kind of where we're at. Scott in the YouTube is letting me know that my audio isn't great. Yeah, I'm still traveling. I'm in Los Angeles this week. I think that sometimes the audio is not as great on the travel setup. So hopefully you're able to hear me enough. From David, regarding the SMCI 5-minute candle, do you enter the trade when you see the volume candle coming in strong towards the beginning of the 10 a.m. candle? Sure. So that's not how. So, if this was a breakout candle, I would argue that it's not. If this was a breakout candle, I would just want to be buying the actual level of the breakout. Like if the daily chart resistance level was, let's say, 47.50, I just want to be buying 47.50. I'm not buying it because I'm seeing the volume come in, but the volume coming in would just be confirmation of the move. So it means I'd have a higher probability of success on the trade than I would otherwise. The way that and I didn't get involved in it, but the way that I discussed trading it in the morning meeting was basically as a breakaway gap trade. So a breakaway gap is when a breakout occurs via a gap, as opposed to a breakout trade, which is when the breakout happens intraday through the price action. So with a breakaway gap trade, you're basically opening above the resistance level. So what I would do is I would go long versus that previous resistance level. And I kind of identified that as 46. It's a little bit rough, but I kind of identified that as 46. You got this high here from June 20th as 46.18. So my idea was basically to look to be long versus 46 because that's the breakout level. So I know that this is sloppy. Like I would love to have like a better downside tail maybe on this 940 candle, like a hammer into $46 into the previous level to have more conviction as a small time frame signal to buy off of. But that's more of what I would be looking to do is kind of buy off of a tail or off of a pivot low into the 46 area for continuation. And then when the volume comes in and it goes and works, then obviously you're good to go and you have all your confirmation there. Otherwise, you could try to buy on this candle, but I don't know why the volume came in when it did. It almost seems like it's kind of somewhat random there. But this is what an ideal breakout 5-minute candle would look like if it was actually breaking through a daily level. It's just that it wasn't breaking through a daily level. So, hope that helps. What else, guys? Anything else from anybody? I don't mind doing short ones this week just because I'm traveling, but I also don't really have anywhere to be immediately, so I'm in no rush. I know Josh was talking about the Amazon chart. I think it looks fantastic. You could look to be long versus 215. The real breakout's like 218, and it's basically testing that right now. I think Amazon looks excellent. Are you a bull or a bear? From Scott in the YouTube. I am a so but someone else asked me this question somewhat recently. I think that you can potentially be like a bull and a bear at the same time. It turns back to the idea of continuity. So I would say very, very generally, there's more to it than this. Very, very generally, we can, for my trading approach at least, you can identify like three. I'm trying to figure out what the right word is. You can identify like three um, more major like thought processes or approaches to trading, and I would break those down into technicals, charts. Um, that's one. Two is market dynamics, understanding the systematic bids and offers and gamma and all that stuff. And three is fundamentally. So my current view on this market, based on those three factors, is basically bullish, bullish, bearish. To be honest, so the market technicals here, you can't look at these charts and say that they're not bullish. They're super, super bullish. At a certain point, they might get too extended, in which case I don't want to chase the long side, and maybe you can even put on some cute shorts because of the extension. But these technicals are bullish. So that's one. Two is market dynamics. Market dynamics, you can make an argument to be bearish tomorrow through Monday off of the pension rebalance, the end of quarter pension rebalance. But beyond that, the market dynamics for the next month basically are extraordinarily bullish. And in a lot of ways, I think that that's the most important of the three things: the technicals, the dynamics, and the fundamentals. The dynamics, I think, are in a lot of ways maybe the most important thing, and the market dynamics right now for the month of July are extraordinarily bullish. And then the final thing I would say is fundamentals, right? And um, what you're saying in the YouTube right now, potential of economic slowdown, geopolitical and policy uncertainty, interest rate sensitivity, I would put all of those kind of into the fundamental basket, and that I am bearish on. Uh, the primary reason I'm bearish is because of the tariffs. To be totally honest, that's the number one thing for me. It's just my study of economics. It's been something that I have for all of my career had a tremendous amount of conviction on, and it's the negative economic repercussions of tariffs that I don't think that we're seeing in the economy yet. And I think that, like, when you think about interest rate sensitivity, part of the interest rate problem, I think, is hand in hand with the tariff problem. As Jerome Powell stated over the course of the last couple of days, we would already be cutting if it wasn't for tariffs. So uh, tariffs, I think, are the bigger problem, but we're still not seeing it in the economic data. So I can have fundamental bearish thought process, but that doesn't matter when the chart looks like this and when the market dynamics look the way that they do. It's just something to kind of have in the back of my head that at a certain point it could create an increase in volatility. It could enable this market to come down. But when is that going to be? What's the timing on fundamentals? The timing on fundamentals is manifested through technical analysis, and the technical analysis portion of things is not confirming any bearish thought process or anything at all right now. And that's actually probably been the hard part for me. Like I as a trader, I want things to line up, right? Like I find that for me, having a fundamental viewpoint for the market really helps me make money because it increases my conviction. But the technicals need to confirm that conviction. So I will make the most amount of money when everything lines up. When well, kind of like what we had at the end of February, at a certain once we had this day to take notice of negative Maribozu basically on OPEX February 21st. That was a bearish engulfing candle. Again, we sometimes refer to it as a day to take notice of. The market's gonna require some real healing in order to improve. So the technicals changed on that day, but they changed in a way that was more in line with my fundamental viewpoint based on the implementation of tariffs. And that was before things got real hectic with the reciprocal tariffs. We just knew tariffs were coming. And um, and we knew that the market dynamics were like actually super risky to the downside at that point. So everything lined up, and it really helped me to do very well, particularly in the month of March, with a lot of that actually being to the short side. Um, in this more recent environment, like I've got this bearish fundamental thought process, but it's at odds with the technicals and the market dynamics. And that's why, the market dynamics I think are the most important thing, and they're manifested to some degree in the technicals. So you can have this bearish viewpoint, but if the technicals aren't confirming it, you get no business actually manifesting it in your trading, unless you want to get hurt and lose some money, which is pretty much exactly what I did. I foolishly allowed myself to allowed my mentality of being fundamentally bearish to override the clear evidence that was more bullish from the technicals and the market dynamics, and that was most definitely to my detriment. And I don't think that that's changed. We're just continuing to squeeze higher here, and it looks like for the medium term over the course of next month, we will just continue to be bullish and bullish and bullish. But in fact, what that does is when things turn, they can turn even more viciously because of the up move that occurs, because you get all of that net long exposure coming back into the market. When you get the systematics fully back into the market, that's actually what eventually enables the sell-offs to be able to happen. So that's kind of where we're at. It's why like mentally, I think I was talking about this with some guys yesterday. Um, I almost would love more than anything right now just to take like a month vacation. Like I want to come back in August because it's a struggle for me mentally to like I want so badly to be pounding the bear side of the market, pounding the short side of the market, and I know it's the wrong thing to do right now. But it's just where my head is at because I think that we're going to see economic deterioration because of all of the tariff uncertainty. And you are seeing it in pieces, by the way. It's just the AI trade and the semiconductor trade is overwhelming any aspect of bearishness that's coming from some of these stocks, right? Like we saw General Mills yesterday report a terrible earnings report, and you see kind of one retail name after the next right now getting really hurt because of tariff uncertainty. General Mills is one of them. I don't think it's a public company, but H&M, the CEO, was talking this morning and saying that their business is really being uh, it, it, negatively impacted by the tariff uncertainty. Obviously, we've seen it from names like Walmart in the past. I know Nike just reported after hours today. I haven't looked at any of the numbers on Nike right now, but it's another one that should be negatively impacted from tariffs. Looks like Nike is trading down real small right now from where it closed. Um, but you need to see that actually move into the broader economy in order for it to impact a Nvidia. Why does Nvidia care? I mean, Nvidia is actually probably a bad example because they are subject to being hurt from like the export controls to China. But maybe Meta or Microsoft would be a better example. Like, why does Meta or Microsoft care about General Mills being negatively impacted by tariffs? For the moment, it doesn't. The only way that it does would be, eh, like second or third level, where at a certain point, the Unilevers of the world don't advertise as much because their businesses are being negatively impacted. And then as a second order effect, you can begin to see like a Meta or a TTD or the other advertising related names actually get hit because the economy is slowing. So the big question is, what does this impact actually turn into? Like we're seeing it from the Walmarts and the General Mills and all these companies, but first of all, those companies have done a pretty good job front loading their their goods to just kind of be ahead of this and kind of help them weather at least the first portion of the tariff uncertainty. And then two is, the consumer is still doing so well. Like you really need to lose the consumer in order to lose the market in a more major way. and in order to lose the retail bid. Because the one thing that's been very, very steady throughout all of this is the retail bid. The only way that any of that happens is if you begin to see layoffs start to come in on the market. So the employment numbers right now for the next quarter, 2 quarters, probably through the end of the year, the employment numbers I think are going to be extremely important. The way that you create, I think, a follow up to a bear market, a follow up to April, the way that you turn an event driven bear market that we had in April into a cyclical bear market is unemployment beginning to rise. Unemployment starts to rise, then they're not spending as much, and then they're also not taking their excess capital and buying at the stock market in the way that they did in February, March, April, May. And that's when things could potentially change. But you got to see it come in the economic data, and even if it hits the other aspect of it when you think about market dynamics, and this was so important in this recent Israel-Iran conflict, is you need the negative data to hit at a time when the market's actually able to go down. Like I just when I think about the month of July that's about to occur, I don't know what could get the market to go down in July. Like, I think that July is going to be very similar to June insofar as bad news comes out and the market can't go down for more than 15 minutes because that gamma number, I don't know what it is right now, but it's going to be dramatically increasing day after day after day. So by the time we're in July, we'll have some really, strong positive gamma again. And on top of that, you're going to be getting buying from vol control every single day. Like I don't know what could possibly make this market go down in the month of July, unless we get something that's so dramatic. Because vol control, like Pat Snow was saying this morning, it is just one subset of one flow, basically of schematics. It is possible for there to be more than I've been estimating that we're going to be seeing $5 to $6 billion a day in buying from vol control. Let's assume on top of that by I don't know the end of the first week of July, we're back to $10 billion or even more of positive gamma. So it means that the only way that the market could go down, let's say, on a given day in the first week of July, and second week of July, etc., would be if an event happens that's so negative that it creates so much selling that it's able to overwhelm 15 to 20 billion dollars of forced buying that could potentially be coming from gamma plus vol control. It seems like it's impossible. But again, as you build all that buying back in some ways, it's like the bigger they are, the harder they can fall. And we'll see how that plays out. One of the things that I also have found to be really interesting, just talking about systematics real quick, is we have so many instances over the course of the last couple of years of systematic exposure getting to full tilt on the upside, where we begin to realize the risk is to the downside, and then you get the sell off in the market that occurs. It's been a very, very common feature. You get everybody in the pool, then the sell off occurs. But every single time when you're back at whatever the last high was, the systematics are not as bought back in as they were previously. So, like, if the sell off in June of last year, sorry, in mid July of last year, if the sell off in mid July of last year, right before it, we were at like the 99th percentile in systematic long exposure, and then we sell down. I'm going to make up a number, and we get to the 40th percentile. By the time we're back at that all-time high, we're only at like the 70th percentile again, and you still have all this additional systematic buying that can occur that gets us to new, consistent all-time highs that really creates this like very, very, very big picture, like uptrend that's been ongoing for whatever decades now, or since like the financial crisis. So I hope that helps. The market's gains are heavily driven by a few mega cap tech stocks like Nvidia, Apple, Microsoft. The sell off in those names could disproportionately drag down the broader indices. Random stock pick with UPS. So I just want to comment on the first part of what you're saying because I don't necessarily agree. What's been so incredible about this market on the way up has been the dispersion effect. And on a day like yesterday was an interesting day because the equal weighted S&P was down 0.75%. 370 of the stocks in the S&P were negative on the day, but the S&P itself was like flat green, and it was just because of Nvidia, AMD, Google, basically. Nvidia up 5% or whatever it was on the day. But we also saw some periods here over the course of these last couple of months, in June in particular, where those stocks didn't trade well. But then they just started short squeezing the IWM, and it was every other stock moving higher while the Apples and Nvidias went sideways. That still enabled the market to move higher. So, and that's hallmark of a bull market, by the way, is rotation. It's like, all right, these names are going today. They take a break. Then the next set of stocks are going tomorrow, and that's just the environment that we're in. What you really need, in my opinion, to get a sell off is not just losing Nvidia and Microsoft. What you really need to get a real sell off is you need the correlations to increase to lose the dispersion trade. Correlations will only really increase if vol increases, if the VIX increases, and you don't really get correlation increases in heavy positive gamma environments. It's the opposite. Like I don't know this as a fact where I've read it off of a chart, but just from what I've seen at least, it seems like the higher the gamma of the market, the higher the dispersion, because the market can't go down, but you get like, was it yesterday that we were like flatlined all day? It was, right? I guess we were a little bit today too. But yesterday we were super flatlined. The indexes were incredibly boring, but there were stocks moving all over the place to the upside and the downside, depending on the name. Um, you can make an argument that enables like a stock pickers market to some degree, especially for day traders, and it can make it a decent market environment. For me personally, I kind of prefer trading where correlations are a little bit higher because I'm a top-down approach trader, starting at the index level and then working down from there. Bill K gave me an excerpt from McGilligan on June 10th's note. But as I always like to remind, in order to have the conditions for crash, you first need. I remember reading this too. All right, so what McGilligan here is giving us, he's giving us 4 points that you need to have in order. These are like the conditions for a crash. So is the market having these conditions? Number one, excess length, positioning, leverage accumulation. So on that first point, we're beginning to see an increase in that. But in fact, the biggest thing that's been driving a lot of hedge funds crazy, I think, on the way up here is that they've been underinvested. They haven't had that excess length and positioning. They haven't had that leverage accumulation. We've only begun to see that, I think, really pick up here in the month of June. And it's still not at like what I would consider to be excess levels. Two, elements of speculative froth to develop in high beta, high vol market segments. I would argue that you are seeing some of that with the short squeeze names, the crazy names, the BS stocks that have been going. Number three, and only then do you get steep skew, where due to said extreme positioning and in high beta speculative sectors and assets, end users then need to hedge their downside risk, which in turn means that dealers would be putting a short gamma, short vega position into a spot sell off, which creates accelerant flow to the downside. This is super important. And, for anybody that's a newer trader, the first time I think I ever read, some sentences that were similar to this from McGilligan, it was like reading Flash. So, take your time with this stuff and mess around with, a Perplexity or a Chat GPT or something like that to learn what all this means. But basically, if you go back to the point, like points one and two, where you get like funds that are out there to be forced to be buying the market, so they're getting excess length to the upside. They're accumulating leverage to the upside. Well, as those funds are putting on more upside risk, they want to hedge that risk. How do they hedge that risk? They do it through options, like buying puts. So that, especially when you're buying like out of the money puts, um, increases the option skew. And what that does is it puts the dealers into shutdown, right? So we've been talking about the market. I spent a decent amount of time in this afternoon meeting talking about how at the S&P level, the market is, positive gamma, right? Right before doing OPEX, we had $15 billion of positive gamma. Positive gamma means that in every 1% down move, everything else held equal, you would get buying. In this case, $15 billion worth of buying that actually comes in uh, to to the market. Um, there's only like a handful of them in there, Bill, so they deserve it. Um, so you're getting like $15 billion worth of buying that comes in on the downside. Where does that positive gamma come from? It comes from volatility sellers, basically. It comes from option sellers, right? So there's a big phenomenon at the index level right now at the S&P where there's all these like cash generating strategies for retirees and stuff like that that are like, covered call selling as an example. So if you're a covered call seller, you are selling options. Selling options, who are you selling it to? You're selling it to an options dealer. That options dealer doesn't want the exposure of being long the options that are sold to them. So they are hedging that exposure with, buying the S&P. And that's dynamic, right? So as the market moves, as time moves, they have to adjust their hedges. The way that their hedges are being adjusted in a positive gamma environment is that into a down move, they have to be buyers, right? That's what option selling does. Option buying does the opposite, right? If you guys remember back in like 2020, I think it was, there was all this chatter when Tesla was going crazy. People were first learning about like gamma squeezes, I feel like, for the first time. And a lot of that was related to there was speculation that I think it was SoftBank had a trader who was almost, for lack of a better term, manipulating the market to Tesla higher by buying options, knowing that the buying of those options became a self-fulfilling prophecy because he's buying options. That means who's selling them? The dealer is selling them. The market maker is selling those options. So that person, they don't want to be naked call options in Tesla if you're just a market maker. That's not how you make money. You don't make money speculating on the market. You make money off of spreads. So the SoftBank call buyer in Tesla is forcing, because keep in mind, calls are leveraged bets, forcing the market makers to buy the underlying stock in Tesla, right? That's what was occurring there. So this is a different situation. So when market participants, like they have been for the S&P, are selling options for cash strategies like covered call strategies, that creates positive gamma, which insulates market movements. When market participants are buying calls or selling, buying calls or buying puts, that does the opposite. What that does is it creates negative gamma for the market. So circling back now to Charlie McElligot's note, the conditions for a crash are one, excess length positioning and leverage accumulation, right? They're buying the market, but they want to hedge themselves, so they are buying puts, especially out of the money puts. That buying of puts creates short gamma. So then, therefore, if the market were to sell off, instead of it selling off into a positive gamma environment, like I'm talking about, where it's $15 billion of buying in the S&P on a 1% down move, at a certain point, when the market sells off, because of all of the hedging that has occurred, all the puts that got bought, it actually creates a short gamma environment where now the market goes down 1% and uh, those dealers, instead of buying $15 billion stock, they are selling stock into the down move. And that, per Sherry's comment here, is a gamma squeeze. That's what that was in Tesla. It was a gamma squeeze to the upside. And to some degree, what we saw in the market in April was like a gamma squeeze to the downside. So, in order to have conditions for a crash, you have to have the conditions for a crash, right? Like a crash is different, by the way, than just like a sell. Like you can have like a, if fundamentals in the economy deteriorate, you may not have the conditions for a crash, but you can actually get a market grind down situation similar to how we've had a market grind up situation. That's different than a crash. A crash is what we saw in April. Arguably, we had some aspects of a crash in late February, first half of March as well. But you need that steeper skew to come in order to be able to do it. And then the fourth factor here, fourth condition for a crash is it says typically from there, the dealer accelerant flows then knock into systematic deleveraging from vol scalers as additional source of synthetic negative gamma in the marketplace. Um, so, uh, so they knock into systematic deleveraging from vol scalers. Yeah, so basically, it's just I think I could broaden that statement. I think just to systematic deleveraging. Period. Where what do we know, right? Like some of the things that we keep a track of, as an example, is the CTA sell triggers that we get from Goldman. We know that they have like a short term, a medium term, and a long term like CTA sell trigger. If we're below it, it can actually become a buy trigger. At a certain point in April, there are buy triggers above spot. But we know, and I haven't had an update on these numbers in a while. I don't know where they are. But if the market were to go down at a certain point, it will force the CTAs to then actually the trend followers to actually become sellers. At the same time, if like right now for the month of July, we're expecting vol control to be huge buyers. It's realized vol compresses compared to the 3 month look back, but um, at a certain point, if the look back is very muted and then volatility picks up, then those vol control guys can become sellers. So the conditions for a crash, I think, combine all of this. You get the excess long positioning from funds because they're also going to have to be selling it on the way down, combining that with the steep skew, right? So then you get like short gamma. So that creates accelerant flow to the downside as market makers have to sell in order to maintain the hedges on their positions. And then at a certain point, you break through the systematic triggers where the trend following algorithms and the vol control algorithms become sellers. And then you put all four of that together, and then you have the recipe for a very genuine sell-off, like what we saw in February, March, and April. And you typically still will need a fundamental catalyst to begin to trigger the entire thing. We've seen periods of time where the conditions are all new, but we don't get the market pullback for a week or 2 weeks or 3 weeks because you still need the actual trigger to occur to cause the market to go down to trigger the skew and the delay. Seems like what we just described, and this is such a good one that I'm gonna keep this image myself, Bill. Um, those things that we just described seem to be the main factor that has moved this market ever since I started studying for this stuff. Um, like the last handful of years, last 5 years or so that I've been studying this stuff, going back through kind of COVID, um, it's all about this. And that's why, to circle back to like Scott's original question in the YouTube, um, you can look at the market from technical analysis, market dynamics, fundamentals. I like when they all line up. The problem for me is I let myself get a little bit hurt on the short side, particularly in the second half of May and June, by by ignoring the market dynamics and allowing my fundamental viewpoint to kind of override what I saw as within those dynamics. So, you need the crash to occur. So when do we crash? Up first, then down. Um, and likely this is back to the Charlie note. Likely, as we do then ultimately see by midsummer, that labor is indeed cooling off and layoffs are starting to pick up. So interesting that that's the final comment that's on here because that's what I was just a minute ago talking about. You need layoffs to pick up. You need the consumer to stop consuming in the way that they are, and also to stop buying the damn stock market in the way that they have. And the only way that that happens is if you see unemployment pick up. And I think personally, maybe time will prove me wrong, but I think that personally, the cover for that is tariffs. Tariffs are the virus. Tariffs are just that's the economic change, and it takes time to bleed that through the economy, especially in this day and age when these these companies have just done such a good job knowing ahead of time that these tariffs are coming and doing everything that they can to prepare for it. But time, we talk about time as Bill's friend in technical analysis all the time. Time is not a friend of the economy right now when it comes to us not getting a deal done on tariffs. I expect that we are going to continue the pause, continue the tariff pause that's set to roll off on July 9th for most, if not every country that's out there. But keep in mind, the tariff pause is still 10% tariffs. The question, it seems like that number is not going to get better than that. The question is 10 and does it get worse? And at what point do we actually see it begin to bleed into the economic numbers? That is what I think the real recipe for a bear market is going to be. Um, and then we want to be prepared for it. And when you circle back to those 4 points that we were just going through, it doesn't seem like it's going to be July. Even if we begin to see an uptick in unemployment in a little way or inflation a little way in July, which we may see, it's just we don't have the recipe for the market to go down along with it. Maybe the more bearish situation for July is we just don't go up as much as I would expect us to because yeah, you've got all this buy flow that's coming in, but it's being met by some degree of selling because of the negative economic data. But it seems more like August, September, which happens to coincide with bearish seasonality, will be the point where I think, and I think you just posted a chart of this. Let me take a look. Um, CTA positioning. Yeah, they're getting up there. They're not all the way there yet. Yeah, they still got some more room to buy, but vol control notional equity exposure, yeah, it's still pretty low, man. But it won't be low after the month of July. I think that there's a good chance that by the time you get through July, then you're going to kind of be hitting that point where everybody's in the pool from the systematic perspective. You'll get more forced buying in as well from funds that creates the excess length, which therefore means an increase in skew. And by that point, when you're in August, September, there's a better chance that the market dynamic conditions become much more ripe for a pullback, right as we are going into the heart of seeing tariff impact on the economy, which then can become your trigger right as these 4 points are coming together. But again, it's still a month away, so I don't know. Maybe I should just go on vacation for a month and come back in August. It's like kind of really what I want to do in the back of my head. Uh, yeah, thanks for providing this info in here, Bill. It's all really good stuff. Derivatives income fund AUM growth. Yeah, that's this chart that Bill posted on the derivative income fund AUM growth. That income fund is exactly what I'm talking about. That's that's what's creating this positive gamma in the market that does not let us go down. Derrick McElligott. Michigan number tomorrow could be important. And again, we are still technically in a small window here to the end of June where the market could go down, but all it's done is create the opposite. Do you think the guidance of some of the bigger names in their earnings may give investors a different perspective? Do you think the guidance of some of the bigger names in their earnings may give investors a different perspective, considering most companies will have to discuss how they will be tackling tariffs? Yeah, I mean, you could maybe you should have seen that in last earnings season, and we did here and there, but it wasn't enough to move the market lower. I think that, I'm sure that there's a chart somewhere that is tracking like how many times the CEO says tariffs on earnings reports over the course of a full earnings season. And so I would guarantee you saw a huge uptick in that on this earnings season that has just more or less ended. And the next earnings season is going to be starting soon in July, and it'll probably be a repeat of that. It's just, the names that we're seeing being impacted by tariffs right now, they're just not um, they're just not important enough to enable the market to go down. Who cares, you know, about General Mills unless you're a specific investor of General Mills? Who cares about General Mills saying that their earnings report was negatively impacted by tariffs? No one cares. The only way that this begins to matter is if we begin to see uh, that commentary from the General Mills of the world be reflected in the unemployment numbers. That's when things will come to matter. And we got to see, we got to see if that can happen. It's also going to be an interesting dynamic at some point. I don't mean to ramble now, so it's going to be an interesting dynamic at some point to see the AI situation, because most likely, again, I know like there's a lot of arguments that AI will create jobs and it will create some jobs, but I'm going to assume could history might prove me wrong. I'm going to assume that the net situation from AI is more layoffs than hires coming from it. You lose your truck drivers. I saw statistics somewhere that I don't remember the exact number, but the being a truck driver is the number one job for males in like 6 states in America. Um, those jobs are going away. Just a matter of how fast. AI is getting rid of a lot of jobs. You think about, and I know, the finance world is obviously something I'm a little bit more intimate with because of what we do for a living. But there's been a lot of chatter recently about entry level analyst jobs at like big banks and stuff like that. These guys are not needed anymore. They're not needed. You don't need them plugging stuff into Excel spreadsheets all day because you can just have AI do it for without having to pay the salary and faster and probably better. There's longer term negative repercussions of that, because there's a lot of data that shows that like the real industry leaders who maybe are in their like 40s, early 50s, whatever, the way that they were able to get to the point where they are, where they're able to be innovative and everything else, is because they started by doing that menial labor as a lower level analyst. And now, when you're not bringing on the low level analysts, 10 years from now, you're not going to be able to have that executive that you would have had otherwise. But, uh, the way that the world works is you're not hiring entry level analysts and paying them a salary because you're saying to yourself, in 10 years from now, this might be my future leader. Especially when, you know, for better or for worse, this isn't like, the boomer generation where you join a company and you join that company at 20 years old and you stay there until you're 65. That's just not the way of the world anymore. You're not hiring a junior level analyst expecting them to be with you in 20 years to be your executive and your leader. Um, it just not calling you a boomer, Rich. Just saying in general. I've been with T3 for 15 years, but sometimes I tell people I've been with T3 for 15 years and look at me like I'm an insane person. How have you been at the same company for 15 years? It's just not the way the world works anymore. But again, we're thinking companies naturally think about shorter term profits. And right now, it's why hire the junior analyst for a $70,000 salary when I can just have AI do it? So you're going to see all those jobs disappear, taxi jobs disappear, factory workers. We're trying to bring back factory working into the United States, but that's just going to be all robots in there. It's going to be all robots, and that's why you circle back to what Jensen Huang was just talking about like a day or so ago about um, you know, robots is really being the future, right? And that's why what did Jensen say NVIDIA is now? That they said we're not a semiconductor company anymore. We're a I don't remember. Somebody's got to tell me. They describe themselves as something different, not a leather jacket company. Um, I'm forgetting, but it was really interesting to see him describe the company as something new. You know, like I don't remember what it is. Somebody's gonna look it up and tell me. But we'll see. Something like that's off of Eli's question. Scott likes UPS. The AI infrastructure. Yeah, AI infrastructure company. That's what they're describing themselves as now. They're not a semiconductor. They're an AI infrastructure company. And I think it's very accurate and fair. They are at the foundation of all levels of AI, whether it's robotics or self-driving vehicles or actual, chat GPT. They are, I think that's a fair term for them. And within the confines of that, he was talking about just how much money they think is going to come from robotics. And then there's a lot of chatter about like the companies that make the robots themselves are going to be more like a General Motors or a Ford, right? Like they're just putting together the hunks of metal. You could argue like a bear argument that you could make about Tesla's robotics division that there's so much hype around is one, it doesn't even exist yet, and there's going to be a ton of competition. But is two that well, all they really are is the car company of the robot, not the AI infrastructure that's behind it. And the AI infrastructure that's behind it is where the money is, it's where the multiple is. So Tesla looks like crap. Anyway, I'm gonna wrap it up there. This was a really good meeting. It went for a while. I'm glad happy to do a little bit of a longer one because we did a couple short ones a couple days in a row, and we covered some really good stuff in today's afternoon meeting. So I think I'm gonna take that one slide that Bill posted and make it my computer backdrop background. Have a great night, everybody. I will see you all tomorrow.